My guest tonight has just written a report that says markets, rather, are akin to biological systems. They have good and bad days. They learn, they adapt, and sometimes they get a bit sick. Well, if volatility is any indication, markets are a bit sick. But just how serious is the illness? Joining me now is Brad Simpson. He's Chief Wealth Strategist at TD Wealth. Great to have you here. It feels like, sick is a good way to talk about maybe the big sell-offs we've seen recently, past couple of days, and we're getting more news about, again, trade, economic growth.
We're talking about the market, right? Not the people watching that.
Yeah, not the people watching this,
Right.
or you. We're talking about
you feel a little sick.
No,
yes.
no.
Yes.
How do you decide when you what makes you think the market's caught a cold? Or is sick?
Well, I think market gets symptoms, right? And I think we wrote this article called Cold Season, and really was the idea, quite frankly, was that interest rates, monetary policy were a little bit like cold drugs. And you're kind of a little bit sick all the time, but if you keep taking them, it keeps the symptoms at bay. But at some point, it catches up with you. And as we all know, you can use the cold drugs for a while, then finally your system gives up, and you have to spend a couple days, and you have to rest. This is a second movement of a return of just normal market volatility in a normal market environment, and normal markets sometimes do get a little bit sick, and that's just all part of the process. So to me, this would be the second cold of the year. Okay.
What are some of the things you look at when you're trying to diagnose the market? I know you've got a list of factors to kind of examine how things are.
Absolutely, and I think it's a lot of things that you would expect, right? Yep. So first and foremost is valuations, right? Is this an expensive market? Well, I mean, even really before this started, we would suggest that it wasn't, but now you're looking at, for the S&P 500, 16.5 times earnings. If you go back to the 1950s, that's kind of bang on where it was. And if you think on average of the PE was around that 15 to 16 times, and that was with an average of a 10-year bond somewhere around 5%. And today you're around 3%. And so you kind of put those together. And then you look at the Canadian market, you look at international markets, they're all kind of trading in that band now. So it's really hard on a valuation part to go, well, this is the reason because they're overvalued. Probably not so.
Okay, interest rates, another one you look at.
Second, interest rates are a big component of it, right? And first and foremost, for the first time in a long time, stock markets aren't the only game in town, right? So on one hand you're starting to be able to go out and get a 10-year bond and a 5-year and a 3-year and a 2-month, and well, lo and behold, they're a pretty good option. The next part of that is as interest rates have gone up, and they've gone up a lot. Like on relative terms, we remember the good old days when interest rates were lower, but we were at zero, right? And now that they're higher, that starts having a dampening effect. So the question really is that interest rates here, they're probably at a fairly healthy level. And if we look at from the perspective of central banks, the Federal Reserve Board was saying before there's 3 more hikes going to come in 19. Now they're kind of saying a little bit like, whoa, we might be data dependent now, right? We're going to kind of call an audible, and we're going to see how this goes from here. So I think that they're recognizing themselves that the punch bowl is a little bit of there as well.
Third component you talk about is inflation, and obviously inflation being one of the things you look at for interest rates as well.
Yeah. No, inflation is actually a really big one. Because I always say that there's 2 things that ultimately make a market correct. There's the known, which is usually a recession. And so that's where most people in my chair spend an awful lot of time trying to think, well, what is the market trying to tell us about where inflation is? Because that's ultimately going to lead to a recession. And so I think if you look here 50 years later, we haven't gotten any better, and the market's not any better saying when a recession's going to come. So we had this given for a long time, there was no inflation. If we look at inflation numbers right now, and we look at the number where you take food out and you take this oil and gas out, and I know like people often think, well those are the 2 things I'm worried about, right? But let's say you take those 2 out, and it's 1.9% right now. But there's wage inflation out there, and we haven't had that for a long time, and that's starting to pick up, and you have really low unemployment. So I think we've got that one circled. right?
Okay.
And you know, today we think this isn't going to be a problem, but boy, the market's got that circled as a thing that we really have to watch, and I think that's prudent to watch it.
Okay, how about the circle around trade? That's another, because I mean that is, I think, part of the reason things are jumping.
Absolutely, for two reasons, right? Well, ultimately, tariffs lead to inflation, right?
Yeah.
You don't say, well, I'm just going to live with this. The manufacturers, they raise their prices, and all down the food chain, that changes it. Mm-hmm. So that's feeding into this fear of inflation right now. And the second part of that is that, you know, we used to have givens, right? We went through a really long period of time where you could say things like, well, interest rates are going to go down. I check. Mm-hmm. That there's going to be quantitative easing. So if I have a lousy asset on my balance sheet of a corporation, well, the central bank will come and purchase it from me. Free trade is everywhere, and that's good.
And growing.
Yeah, right? So now we're living in a very different environment now, and it's a big question mark, because ultimately it leads to volatility because you get the politics of it involved, but ultimately in the S&P 500 you have these multinational corporations that at the end of the day, if you continue to have tariffs getting jacked up, it's ultimately going to impact earnings.
Credit spreads, the last of the kind of five main things you're looking at. What are you seeing there?
Yeah, and you know, and I think credit spreads are always kind of the forgotten thing, because so often in markets people are talking about equities and how it impacts. I think credit is really the thing you want to keep an eye on.
And what's happening?
And really the deal is that you want to see the difference between a government bond, an investment grade bond, and a high yield bond. We got to the all-time lows of that. So that's your spread between those three. It's been increasing over the last few months, but just a little bit. But what we really want to watch, and I think it's actually quite impressive how much they've hung in. Mm-hmm. But that's a real area of the market we want to watch. And on my team, we spend an awful lot of time talking to credit folks, looking at credit markets, talking to people about that, and trying to get a real take on that.
I've only got about a minute left, but given valuation, interest rates, inflation, trade, and credit spreads, and what you're looking at,
right?
You said you feel like the cold. We maybe got another cold in the markets. Yeah. But then, so what's the diagnosis, or what's going on? What's the diagnosis, and what do you do about it?
I think the thing to do it is where this ultimately goes, is that we have to get out of the business of trying to predict when we're managing money, right? You have to adapt. And for us, that's always what it's about. Adapting to the times that you're around you. We've been talking an awful lot for the last couple of years that we're moving into a new environment. And in an environment like this one, we're going to see times like we're seeing right now. We think we're going to see more of this over the next couple of years. Really, we think the time is actually to step back, start making adjustments to your portfolio to suit a very different environment than we have today than the one we had for the last 10 years.
And I've only got about 30 seconds, and I'm not doing this justice, but we've talked about how you look at risk in portfolios. And again, the components of the portfolio are more than just your bonds and equities.
Yes, absolutely. Yeah. And I think that's the adjustments I'm looking for. You don't have to own an investment portfolio that's predicated on the stock market going up and interest rates going up or going down and making bond prices go up. Add different components to your portfolio of investments that actually get their return from other sources.
Brad, always a pleasure. Thanks so much.
Great, thank you.